All right, so here's day 11 of my stock market portfolio. I'm recording this August 22nd, and I'll also be uploading it August 22nd. All right, so if I look at the equity in my margin account, you can see that it's down. Oh, this is in US, but in Canadian, it's down to 35.82. Markets seems like some of my positions are down today, but as well, I moved 100 shares of Macy's to my TFSA. So it brought down my margin equity, but it increased my TFSA equity to 43,236. And then my RSP is at 17,140 in equity. So that gives me a total of 63,954. So I'm down compared to the day before. So yesterday I sold a put credit spread on Tesla expiring September 20th at a 200 strike. So basically I collected $100. As long as Tesla stays above $200 come September 20th, I keep the $100. My maximum risk is $400. And that happens if Tesla is trading below 195 come September 20th. But at any time between now and September 20th, I can close the trade early for a profit. So if that $100 becomes, let's say, $50, then I could just close it out early and I keep the difference just to remove risk, because I know anything can happen. In fact, the trade today, Tesla I think it's profitable. Actually, no, it went down. So yeah, actually today I collected $100 from this. Right now, if I want to close it, it would cost me about $1.10. So I'd be losing $10 if I close this trade today. This morning, actually, Tesla was trading at 222. I was able to close this trade for about $90. So I sold it for 100 yesterday. I could have closed it for 90, but of course, I'm not going to close it for $10 profit. And with commissions, I'd be left with nothing. But it's just the idea that I can close a trade early if the trade starts moving in the right direction. Or if I want, I can wait till September 20th. As long as Tesla is trading above 200, I keep the full $100 profit. So that's $100 over 400, which is 25%, 25% in 30 days. So here's what I normally do when I start my day, or when the market opens. I go to my portfolio or my watch list, or I go to my watch list on Yahoo Finance, and I just sort by the biggest winners, biggest losers, just to look for opportunities. And as you can see here, L Brands dropped 8% today, so that's a major drop. I do have L Brands bought it at 26. So if I didn't have L Brands, I think this would be an opportunity. I would go buy L Brands and sell a call option against it. JD dropped as well, but 29 is still considered high for JD because it was trading lower at some point, much lower. Uber dropped, that's not good for me. Teva dropped as well. Mattel, I already sold a call option on Mattel. So it looks like the general market is down today. Lyft would be an opportunity, but I don't think I want to put 100 shares in Lyft right now, so $5,000, I don't want to do that. So just by looking quickly, most of these stocks, I don't see any opportunities for me. Facebook would be nice, but if I do a covered call trade on Facebook, it would require $18,000. Unless I sell a put credit spread, which let's see what it gives us actually. If I sell a put credit spread on Facebook, so let's say in the next 30 days, I don't think that Facebook will trade below 170. All right, so let's see what that would give me, what kind of profit I can get. So expiring September 20th, so in 29 days, a put credit spread on Facebook so I would sell the 170 put and then I'd buy the 165 for protection. I'd be able to collect about $80, risking $420. And so I keep that $80 if Facebook stays above 170 come September 20th. But at any time, I can close a trade early if Facebook starts to move up. Let's look at the probabilities, and this gives me a 20% chance of being right. If I want to increase my chance of being right, I can choose a 165 strike and then a 160 for protection. Of course, I'm going to collect a smaller premium, about $50, but I have a 12% or a 13% of being right. If we look at the math to see if the pricing makes sense, I have a 13% chance of I have a 13% chance of losing $450. So I need to collect at least $58 for this trade to make sense. Right now, I'd be collecting $50, so this trade doesn't make sense. But if I take the 170 strike, collect about $80 with a 22% chance of being right. So I have a 22% chance of losing $420. So I need to collect at least $92. So this trade would also not make sense. So let's see if I go to 175 and then 170. I've got a 33% chance of losing about $380. So 33% chance of losing $300 and let's say $75. So that's $123. So this one breaks even. This one would be good. Based on the probabilities, I would break even. So the only way I'd make profit on these types of trades long term is if I close the trade early. But of course at 175, it's very close to 180. But if you're going to assume that Facebook is only going up in the short term, then this could be a safe trade. Not sure I'm going to place it though, but just trying to share my thought process when the market is open. So first I try to look for opportunities by looking at what dropped hard. If I didn't already have LB, I would have bought LB. Actually, let's go see what kind of, if I didn't already own L brands, this is the trade I'd be making with L brands. I'd do a covered call trade, let's say expiring September 20th, so 30 days out. I'd go at the money at 18. So I'd bought this position to get in would cost me $17.15, and my max selling price is about 18. So the difference is my profit come September 20th. So this covered call trade on L brands would give me a return of 15 of 5%. It would give me a return of 5% in 4 weeks, since there's 4 weeks left, which of course is very good. So 5 divided by 4 times 52 is a 65% return per year. Actually, I might do this trade if I have enough money in my RSP, because that's where L brands is right now. It's in my RSP. See, I bought it at 26. Right now it's trading at 18, but I had already sold a call option expiring September 27th. Let's see if I have any. Yeah, I don't have enough to buy more L brands in my RSP, but I could do it in my TFSA or margin if I wanted to. But I mean, all my retail stocks are going down, so maybe it's not a good idea to buy more retail stocks. Like Macy's went down, L brands now just went down. So I think I'm going to stay away from retail for now. So I've got some credit spreads on the SPY that I'm thinking of closing out early. For example, let's look at this one here. This one expires September 13. I keep the profit of $80 if it stays above 277 come September 13. It has a good chance, but if I can close the trade out early, then why not? See, this morning, the SPY was at 293. Right now it's at 290, 291. So it already dropped from this morning. I actually should have closed this trade early this morning to confirm a better profit. Right now I'm at 47. So I'm not going to close this trade early because the profit is about, if I close this trade early, I'd make a profit of 40 minus $12 in commissions. Not worth it, especially that I think there's a good chance that by September 13, the SPY will be above 277. So if we look at this one here that expires September 3rd, this is an iron condor. I need the SPY to stay below 305, but above 280 come September 3rd. I think there's a good chance. It's at 290 right now. So I can close this trade out for 45 cents right now. My profit on this is about, initially going into this trade is about 65 plus 30. I think it was about $105. So as you can see, I'm already profitable on this trade. I'll be profitable of about 30 and 25. So if I close this trade early, I'll have a profit of about $50, $55 minus commissions of 16. It'll be around $40. But I think I'll wait a bit because I mean, I'm far from both borderlines, both limits. So I can hold on to it for a bit. Now, the one that I really should close is this one expiring Monday, August 26th. I need the SPY to be above 290, and right now it is at 290. So anything can happen. It could easily be below 290 come Monday. So I prefer to close this trade early. Right now, if I close it early, I think I would break even. I'm up $34 on the call side, but I'm down. Actually, I'd be losing money. I'd be losing about $20 on this trade if I close it early. But it's better than losing $400 or $380, right? So I could close it early for $20 for a $20 loss overall, or I can wait and see. I think this morning it was a 293, so I'm gonna wait to see what happens. I'm not gonna close it early right now. I'm gonna look at the other iron condor I have expiring August 28th, so next Wednesday. This one also shows a loss of about So this one shows an overall loss of $90. So I can close this trade early for a loss of $90, but to avoid an even bigger loss if I keep it, because I need the SPY to be above 292. But what's frustrating is this morning it was at 293. So I'm gonna wait, but I'm ready to close it out early for a loss if I have to, because I don't trust what could happen next week. Now I've got Uber. I bought at 40, but I collected $2.05 on the first call option in the first month. Or actually, it was a 2-week trade actually. But now this stock is trading at 34, and I want to sell another call option, of course. But then when I look at what I can get, if I go, let's say, to September 20th, and I go to a 40 strike, I'm collecting $10 or $15, so not worth it. Let's say I go to 39, I can collect $20. If I go to 38, which is my true cost, but then I'd be missing out on my $2 profit of last month, or so I'd collect $30. So this is one of the problems with covered calls, is what do you do when the stock drops hard, far from your strike? Do you sell a call option closer, risking to lose your shares at a price lower than what you bought it at? Or do you stick to your strike price, but then you're forced to go further out? So let's say I go to October 18th, sorry, at a 40 strike, I'd collect $40. But it's kind of frustrating that in 2 weeks I collected $200, but now in 2 months I collect $40. So it's a big difference, but it's because the stock dropped. So what do I do? Do I wait until the stock comes back up, or do I just sell and accept what I can get? So $40 on a cost of $3,800, that's 1% in about 10 weeks, or let's say 9 weeks. So times 52, that's 6% per year. I mean, it's not great, and plus I'll be tied up for 2 months, for 57 days. So I'm not sure what I'm going to do yet with Uber, but my option is either to wait for the stock to come back up before I sell another call premium, or I stick to September 20th expiry date, but then I choose a strike price that I think Uber will not reach come September 20th. According to the delta here, so if I take let's say a 38 strike, there's a 24% chance that it reaches 38. So odds are on my side that it doesn't reach 38, but I mean, anything can happen. So if it does reach 38, then I have to buy back the option if I don't want to sell, if I don't want to lose my shares at 38. So that's one of my options. Or I can go to October and sell. I can go further out, keep my strike of 40 just to be on the safe side, and maybe collect more premium, even though it's not that much. Let's see if I go to December 20th. Of course, not a good idea. That's 3 months or 4 months. I'd collect $120 if I go all the way to December. So I'm leaning more towards waiting, and then my next option would probably be to just go for it and just take the risk and sell at a 38 strike, and hope that Uber doesn't go from 34 to 38 in 4 weeks. Although it can easily do it, but that's probably I wouldn't do it, because I know that Uber has the potential to move a lot because it's a new stock. So I probably wouldn't do it. I've got the same issue with American Airlines. I'm trying to sell a call option that my strike is 31.5, but I can't get anything at 31.5. So either it looks like I'm gonna have to sell something lower. So 31.5 gets me $5, so that's nothing with commissions, after commission. So if I go to 30, I get $13. So really the only one that makes sense really is 28.5, but my strike is 31.5. I don't want to sell below 31.5. So if I take a strike of 29 or 28.5, I collect an okay premium, but I risk losing my shares at 28.5 if American Airlines is trading above 28.5 come September 20th. So I think I'm gonna wait till next week, see what happens, and then next week I'll make a decision. But yeah, I want the SPY to go back up, because I had a chance to close out these trade at least August 26 and August 28. I want to close them out. All right, so I'm not gonna make any trades because I want to see what's going on. I want to have enough buying power. But if I would make a trade today, just based on today, would probably be something on L brands, but retail is not a good idea, so probably not. AMD is taking a small drop. Facebook, I'm very interested in Facebook. So maybe another iron condor on the SPY, or a put credit spread on the SPY, or even Facebook. An index of the general market is always safer, right? So let's try a vertical on the SPY, or even an iron condor. Let's go for September 20th. So the way I like to place my iron condors is to go 1 times expected move on each side. So how do I get expected move? Well, I pick the strike that the stock is trading at currently on the call side, and then same thing on the put side. I see how much the premiums are trading at. So you can see that it's trading at $5.28 and $5.65. I add them up, so it's about $11. So the expected move on each side for the SPY in the next 30 days is about $11. That's the expected move. Doesn't mean that it's gonna do exactly that. It could go over, it could go lower, but probabilities are, I think 75% of the time, based on past stats, 75% of the time, it does not go above expected move. It stays below, it stays within the expected move. So my limits will be $11 over the current price on both sides. So 291 plus 11 is 302. And then on the put side, 291 minus 11 is 280. So these are my limits. And then for protection, I usually go $5 out. So my max loss is $500. So 302 plus 5 is 307. And let's see what kind of premium that gives me. It gives me a premium of $1.30. So it's not bad. You can see how much I'm getting from the call side and how much I'm getting from the put side. It's a probability of, so I have a 40% chance of losing on this trade. A 40% chance of losing. So I can collect $1.30 with this trade. If come September 20th, the SPY is trading between 280 and 302. But of course, I'm not going to wait till September 20th. If I do this trade, I'm going to have the intention, I'm going to go in with the intention of closing it out early, because the numbers don't make sense. The probability wise, the math doesn't make sense, because I have a 40% chance of losing $500, or sorry, I have a 40% chance of losing $370, which is the difference between the 500 and what I'm and the premium I'm collecting up front. So $148. So that means I need to collect at least $148 up front for this trade to make sense. So as you can see, I'm collecting only $130. So it's close, but math-wise, it doesn't make sense. So the only way I can recover from this trade is if I close it out early. So I wouldn't hold on to it till September 20th. But this would be a trade I could make today. And so if I wanted to place it, I just click send order and send order. I'd collect $129 minus commissions of $8. So yeah, this was my day 11 stock market portfolio. So if you have any questions or suggestions, leave them in the comment section below. Like always, if you can open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Thanks for watching.